Today we're diving into one of the biggest divides in global accounting, IFRS versus US GAAP. Two accounting standards, two frameworks, two philosophies. One global economy trying to make sense of both. Let's unpack what they are, why they differ, and how those differences shape financial reporting around the world. What are IFRS and US GAAP? Let's find out. IFRS stands for International Financial Reporting Standards. It is used in 110 plus countries worldwide. It is developed by the IASB, International Accounting Standard Board, and it is designed to reach global comparability and transparency. And US GAAP stands for US Generally Accepted Accounting Principles. It is used only in the United States, and it is developed by the FASB, and it is designed for providing for detailed rules and strict guidance. Both accounting frameworks have their core philosophical differences. IFRS is principle-based. That means it depicts broader guidelines and thus more professional judgment. Think of IFRS as, tell me the goal and I'll choose the best path. US GAAP, on the other hand, is rules-based. That means detailed instructions and therefore less room for interpretation. Think of US GAAP as, give me the exact steps and I'll follow them. Okay, let's next look at 6 key differences in the two accounting frameworks. Starting with inventory accounting. US GAAP allows LIFO, last in, first out method. IFRS, however, prohibits LIFO. This affects cost of goods sold, profits, and taxes. Revaluation of assets. Under US GAAP, revaluation is not allowed. And under IFRS, companies can revalue property, plant, and equipment to fair value. This impacts the leverage ratios and the balance sheet strength. Impairment testing. US GAAP is based on a 2-step test, and reversals is prohibited, whereas IFRS is limited to a 1-step test, and impairment reversals are allowed. This influences earnings volatility and asset values. Financial statement presentation. US GAAP demands more prescriptive formats, and IFRS allows more flexibility in structure and line items. This leads to different formats in the presentation of the financial statements. And finally, consolidation rules. US GAAP's consolidation rules are a mix of control and risks and rewards checks, whereas IFRS focuses on control of the entity to determine how to consolidate it. This can change whether certain entities appear on the balance sheet. Okay, so much about the key differences. Now you might ask yourself, why do IFRS and US GAAP differences even exist? Accounting standards didn't start globally, they started locally. US GAAP grew out of the US financial markets, which are highly litigious and extremely detailed. And a result, the rules-based system is designed to reduce ambiguity and lawsuits. IFRS, however, grew out of international cooperation and trade, especially in Europe. Result, a principles-based system designed for flexibility across many countries. In short, 2 different environments, 2 different philosophies. And now wrapping up. IFRS and US GAAP are not just 2 sets of rules. They are 2 different ways of seeing the financial world. IFRS emphasizes global consistency, flexibility, and economic substance. US GAAP emphasizes precision, legal clarity, and detailed guidance. These differences exist because the US and the rest of the world evolved under different legal, cultural, and economic conditions. And they matter because they change how companies look, how investors decide, and how global markets function. We hope this video has helped you to understand this topic further. See you in the next video, and have a good one.